Happy New Year. This is Ricky Walters, the Mortgage Wise Guy, January 3rd, 2023, giving you the housing and interest rate forecast for 2023. One of the things that makes me a Mortgage Wise Guy is I know who to follow to get the best information, and that would be Barry Habib with MBS Highway, who has basically allowed me to plagiarize his presentation. He's winner of 3 of the last 4 Crystal Ball of the Year awards for most accurately predicting where interest rates and the housing market would go. So he knows what he's talking about. Our first slide here is what drives mortgage rates. Many people think because the media does such a crummy job of communicating what affects mortgage rates that it's the Fed that most directly affects mortgage rates. Well, as you know, many of you know that in November and December, they raised the overnight federal funds rate 1.25% combined between the two Fed increases. Excuse me. Well, during that time, mortgage rates on fixed rate mortgages fell almost 1%, 3/4 to 1%. So while the Fed was raising rates, mortgage rates fell. So clearly there's not a direct impact there. What really does directly impact is inflation. Biggest enemy to mortgage-backed securities and government bonds. You can see this lower line here is the consumer price index, the core CPI, which is one of the inflation reports that we get every month. There's 2 others, the PPI, Producer Price Index, and the Personal Consumption Expenditure Report. And the Fed looks at all 3, but we're looking here just the CPI. As you can see, it generally tracks with interest rates kind of flat when inflation is flat and spikes when inflation spikes. But right here in January of this year, January of 2020 to January of 2022, a year ago, the Fed had a QE or quantitative easing period where they were buying up all the mortgage-backed securities and government treasuries they could find to keep interest rates artificially low to spur economic growth. Well, that worked great until inflation started to get out of control. They ended the QE period, and once they did, instead of it staying artificially low, you can see it spiked pretty good and started following now what inflation was doing. And as inflation has moderated, so has mortgage rates moderated. All right. Here's another chart of CPI going back the last year and a half. And you can see that we're replacing a lot of numbers at the end of 2021 with lower numbers as inflation just started to moderate in the November report, which was October's actually, and the December report, which was November's, showing lower and a decrease in the inflationary pressures in the CPI. And we're replacing numbers from the previous year that were 5s and 6s with 3s and 2s, and hopefully even some 1s coming forward. And we're really going to see a deceleration of inflation. One of the main components when the government looks at the CPI rate is the core. The core part of the CPI is 39% of the core is the shelter costs. In other words, rent, apartment listing rent. And because leases are signed a year at a time, it takes time when they go up for this curve to come back down. And so you see the average, even though we're seeing a decrease on this blue line of actual rents in the present, we're seeing an increase because it's a lagging indicator. It's kind of like if you've ever been on a roller coaster. I'm sure you have. And if you're in the front of the roller coaster, you're going down at the peak. If you're in the back, you're going up. And if you're in the middle, you're just at the peak. Well, that's where January is on the CPI. So as we get into the February and March reports, this whole roller coaster is going to be on the downside, and we're going to see inflation coming down even more. All segments are lower except shelter in the core CPI. So prices have come down across the board for everything basically except the shelter costs, which are a huge component of CPI. And this is why we're very optimistic to say that, that inflation is moderating and coming down. So this chart shows us that there's a normal spread between mortgage rates and the 10-year Treasury yield of about 175 to 200 basis points, or let's say another way, 1.75% to 2% difference between where the 10-year Treasury yield is and where mortgage rates are, okay? 30-year mortgage rates. But that spread got much wider towards the end of the year as inflation went up and up and up, because the servicing value that servicers who service your mortgages count on knew that they weren't going to be keeping 7% loans on the books for very long when interest rates came down. So they were predicting, excuse me, I'm gonna drink of water here. They are predicting also that interest rates are coming down because they're increasing the spread as the servicing value goes down. And that will begin to teeter the other way, excuse me, and it already has, as the last two inflation reports came out in November and December. So now the spread is only about 260 or 2.6% instead of 1 3/4 to 2%. And you can see this normalization of where it used to be and where we are today. Another chart here showing the difference between credit card and revolving debt and the personal savings rate. We're seeing that people going into a recession, you can see people are using their credit cards to live on, and people are using their savings to live on. Unfortunately, this can't continue for very long. It doesn't take a mortgage wise guy like me or an award-winning economist to realize that this can't go on forever. And pretty soon, people are going to hit a brick wall with no more savings and no more credit card limit to be able to charge on. That's what causes recessions. Here's another indicator of recessions. It's the inversion of the yield curve. If you've ever heard that before and wondered what that meant, the inversion of the yield curve simply means that the longer maturity, the 10-year, is supposed to always give a higher yield than the 3-month shorter term treasury. But when an inversion happens, it's the opposite. The 3-month is giving a higher yield. We see here this dip below the red line. That's an inversion, predictor of a recession. Same thing here, below the red line, the recession comes immediately after that. Below the red line, recession, et cetera, et cetera. So we haven't had a recession called yet, and I bet most of you didn't realize that there's a National Bureau of Economic Research, and that is the government agency that's tasked with telling us that we were in a recession. They don't really help us going into a recession to predict it, but they can tell you when you've been in one. And so they're the ones that call it, and they haven't called it yet. So what else is going on during a recession and in our outlook for housing? Well, normally the demand was kind of chugging along last year and in 2021 at about 1.75 million in household formations per year. But we dipped towards the end of July and in September going into the end of the year. Why? Because interest rates were higher, and lots of people took a step back and said, I'm just going to wait this out. It's too expensive. My affordability is gone. All kinds of good reasons. But are we getting help from the builders? Well, the builders didn't really build a whole lot more to give us more supply. And you can see the disparity now between new supply and household formations is only about 100,000, but we're on the positive side of supply to demand. The reason that is, instead of the 1.75 that we were seeing, is because people are freaked out by higher interest rates. What about home moderation, home price moderation? Lots of people in the media, again, getting it wrong, are saying it's a bad time to buy a house. You hear the Diana Oliks of CNN of the world always saying it's a bad time to buy a house. But I don't know any clients that I've helped over the last 10 years that have ever told me, gosh, Ricky, I just wish I would have waited longer to buy my house so I'd have less equity. No, they all say, gosh, I wish I'd have bought my house sooner. I wish I'd have gotten in the market a year or 2 or 5 years sooner than I did, because I'd have even more appreciation, even more value in my home. And just in the last 2 years, the average appreciation nationally has been up 39%. And even though we're down 2.5% from the peak of appreciation in the summer nationally, we're still up 8 to 9% for the whole year of 2022. What about affordability? I mentioned that a moment ago. Well, affordability is nationally, if you had to get a loan for 400,000 and there's a 10% appreciation in the cost, you got to get a more expensive loan. And not only that, now interest rates are higher. So that's increasing your monthly payment, those two factors over 1 year, an increase of $900 plus a month for the average household in the US. But we're not taking into account the increase in income. Fannie Mae and Freddie Mac keep data, and they say the average household income is $9,000 nationally. So that means with an increase from ADP, the average increase is 9% over the last year because of people staying at their jobs getting raised and people switching jobs getting a bigger raise. So it's weighted at 9% average. Then you can see there's a difference of about $100 in negative as far as affordability in this situation. But wait, we got to add in all these other things, gasoline, food services. So it's really a little bit more negative than that. But wait again, what if there's a 5% increase in your income going into the next year and interest rates actually go down? Well, then that flips on its head, and your affordability going into the next year, you're way further ahead if you buy a house now and then refinance down the road with better affordability and lower interest rates. So the housing forecast is here. We believe lower inflation is coming for all the reasons you saw in the data in this presentation. There's a recession-like slowdown coming. Pretty much every economist is predicting it. Incomes are increasing to help affordability. The data shows us that. The very tight inventory environment is going to continue, and rents are still expensive and rising. So the projection is for low single-digit appreciation, so 3, 4, 5% in average in the U.S. Obviously, it's different in different locations, but that's average across the U.S. for the next year. And the mortgage rate forecast is we have some headwinds. We have global quantitative tightening, and that's affecting what we can see with interest rates improving. Lack of foreign central bank buying, like quantitative easing. No one's doing that. No nation is doing that right now. And there's a lot more debt that has to be financed, of course. What we have some nice tailwinds helping us get to our destination of lower inflation and lower interest rates. Inflation being the main driver. Excess retail inventory, that means that you go to the store to buy something, because they have too much inventory, they got to put things on sale. That's deflationary and bringing inflation down. Increasing the mortgage servicing value, we mentioned that earlier, and the likelihood of a recession coming. Did you know that during recessions, almost every single recession that we can look back historically in the last 50 to 60 years has seen interest rates improve? Why? Because the economy slows down, and then interest rates come down as inflation moderates during a slowdown in the economy. So our projection is 30-year fixed rate mortgages are going to move near 5%. Can you believe it? During the first half of 2023, and the U.S. 10-year Treasury yield is going to be at 3%, and we believe even lower in the high 2s. So low 5s to high 4s for 30-year fixed mortgages are coming again, and there's going to be a flood of buyers that want to jump back in the market. So if you're a buyer and you're thinking about buying a home or waiting, now is the time to act, because as more people come back in, you're going to have more competition, lower interest rates. Sellers are going to get confident in raising prices, and it's just supply and demand. When there's more buyers, when there's more competition, prices go up. So divorce your landlord, marry the home, and date the rate, and then you can refinance as rates go lower 6 months from now and get the home of your dreams at a much better deal right now. You've been listening to Ricky Walters with Landmark Lending, certified mortgage advisor, the Mortgage Wise Guy, and I hope you have a great 2023. Thank you.